Hi there, welcome back to another episode of the Art of Business English podcast. Episode 216 today, and we're going to be looking at 10 must-know expressions for finance. Okay, so they're a little bit difficult, but if you want to work in business, they're pretty much essential. So I hope you enjoy them, and let's dive in and take a look. So in the world of business, understanding key expressions and concepts is successful for business. Whether you're a seasoned investor or just starting out, having a solid grasp of terms like cash flow, return on investment, ROI, balance sheet, and capital markets can make a significant difference in your financial decision making. So in today's episode, we will explore 10 must-know expressions that are essential for anyone involved in finance. From hedge funds to risk management, we will delve into the intricacies of these concepts and how they impact the financial landscape. So let's dive in and expand our knowledge of essential vocabulary for finance. So the first one on my list is cash flow. So what is it and why is it important? Well, basically, it's a company's ability to generate and utilize cash. And this is determined by its ability to generate revenue and profit. So revenue is the amount of money a company brings in from its sales, okay? And profit is the amount of money a company has left over after it pays its expenses. Simple, no? So cash flow is important because it's the measure of a company's ability to pay its debts and also to meet its financial obligations. So it's also an important factor if you're an investor in determining a company's creditworthiness and its ability to access capital markets. Okay, so if you have got good cash flow, you're going to get access to credit and investors, and the bank's going to be your best friend. So let's take a look at the next one, which is return on investment, or ROI. Now, the most important metric for evaluating an investment is what is its ROI. So ROI, or return on investment, is the most important metric because you want to get your money back. You know? When you put money into something, you want to get it back and then make a profit. So it's a measure of the profitability of an investment, and it's basically calculated by dividing the net present value of the investment by the initial investment. So if you have a net present value that's positive or more than your initial investment, then you've made money. If it's less, then you've lost money. It's very simple, no? So why is ROI important? Well, it is important because it is a measure of the profitability of your investment. And it's a way for you as an investor to compare different investments and to evaluate the performance of your investments over time. So I hope that's clear. Okay, ROI is really important because if there's a negative ROI, you're losing money on your investments, and no one likes that. So let's move on to our next one, which is balance sheet. Now, this is a snapshot, so a moment in time, of a company's financial health. So the balance sheet basically is what we can see the status of a company's financial health at a specific moment, okay? And it looks at the company's assets, its liabilities, shareholder equity, things like that. Okay, the balance sheet can be used to basically assess a company's financial strength and also as well as its ability to meet its financial obligations. Okay, so the balance sheet is super important, and it's really important if you're an investor or if you're a creditor. And for other stakeholders. It's for people. It helps people evaluate a company's financial health. Okay, so it can be used to assess a company's solvency. Solvency means how much money it's got, liquidity, you know, any risks and its liquidity. Okay, so the balance sheet is really important. It can also be used to compare a company's financial performance to its peers, so other companies in the sector. Okay, so you can compare the two or three companies using the balance sheet. So let's now move on to the fourth one on my list, which is capital markets. Now, these are the engine of the global economy, okay? The global economy is basically powered by capital markets. because they provide the essential link between those who have money to invest and those who need money to finance their businesses and or projects. So simple, capital markets is where all the action happens, okay? And it's also where companies and governments can raise money. Raise money means they can get money from these markets by selling stocks, or they can do an initial public offering, which we're going to look at later, an IPO. So they can also raise money by selling bonds. So bonds are basically, if you issue bonds, this is money that you get that you say you'll pay back later with a little bit of interest. Okay, well, another one. All right, so that leads us on to our next one, which is hedge fund. Now, everyone's heard about hedge funds, but what are these crazy things? Basically, they're a high risk, high reward investment vehicle. Okay, so a hedge fund is a type of investment vehicle that is typically only available to accredited investors. So, professional investors. These types of people are usually high net worth, or they have a lot of money, they have high incomes, and they're also quite sophisticated in understanding financial markets. So typically a hedge fund is not for everyday person. A hedge fund, what they do is they will typically invest in startups, so companies that are just beginning, or early stage investments, so companies that have already been started but they look promising. And these companies will potentially go public via an IPO, which I mentioned before. And that's when these small investments with hedge funds become big investments and make a lot of money. So think of things like Coinbase, they had an IPO. Airbnb, they started out as a small company. They got investments from hedge funds, and then they went public, IPO, and people made lots of money. So the goal of a hedge fund is to generate a lot higher returns on an investment than what is possible in the stock market, okay? So hedge funds can be very, very profitable, but they can also be very risky. For example, I think 9 out of 10 hedge fund investments don't really work out, and then there's one that's we call a unicorn, that's like boom, yeah, and everyone becomes really, really rich. Okay, so let's move on to our next one, which is net present value. Okay, now this is a tool, an essential tool for making investment decisions, because net present value is one of the most important tools that investors and managers can use to decide or measure the amount of money that an investment will return. They take into account things like the time value of money. So the NPV of an investment is the present value of the investment's cash flows minus the investment's initial cost. So if the NPV is positive, the investment is profitable. If the NPV is negative, the investment is not profitable. Okay, so NPV is also used to compare the profitability of other investments with different risk profiles. So NPV is also very important, okay, and probably one of the more confusing ones, okay. If you want, you can go deeper into that, but we'll look at that at the end of the episode. So that brings us to our next expression on the list, which is risk management. The assessments of risk and the implementation of controls to mitigate risk. Risk management is essential, as I said, for protecting against potential losses. So by identifying and assessing risks, organizations can make informed decisions about how to best protect themselves, okay? But it's not always possible. So basically by implementing controls to mitigate risks, the likelihood and the impact of potential losses is lowered, okay? But that's not always the case, because we've seen what happens with companies and banks, for example. We just saw what happened in America not long ago with some smaller regional banks. They went because they didn't manage their risk properly. All right, the next one is the Securities and Exchange Commission, or the SEC. Now, this is a regulator of the securities markets, okay? It's a very important organization. The Securities and Exchange Commission basically is the official agency of the federal government of the United States that's job is to regulate markets. And their primary mission is to protect investors and maintain the integrity of the securities markets. So they've been very active with this whole crypto boom because lots of scams have happened with crypto, and so the SEC has been very, very much on to all of these companies, making sure they follow the rules. So let's look now at the ninth one on my list, which is what I mentioned before, initial public offering or IPO. And going into more detail, a company's first sale of stock is its initial public offering. Okay, it's when a company sells stock or shares to the public. Okay, now this can happen mainly for a new company, or it can be an existing company, okay, that is going public for the first time. Just this week, ARM, which is a chip maker, they went public in New York. It was a big IPO, and I think Instacart is going public today. So these companies were private and then they become public, okay, and they do it to raise capital, such as for expansion or to pay off debt. Okay, so going public can result in a loss of control for the company's founders and the management, as basically they will no longer own a majority of the company's shares unless they buy them in the market. Okay, so that basically brings us to the last expression on our list today, which is derivatives. Hey, derivatives sounds scary. It is a bit confusing. So basically, financial instruments that derive their value from an underlying asset in finance are a derivative. So basically, it's a financial instrument that gets its value from a primary asset. Confusing? Yes. Let's think of it simply. All right, so think of it as a contract between two parties that is based on the value of something else, like a stock, a commodity, or currency. So I'm going to give you an analogy. Imagine you and a friend make a bet on the outcome of a soccer match. If your favorite team wins, your friend will give you $10. But if your team loses, you'll give your friend $10. The $10 represents the value of the bet, which changes depending on the outcome of the soccer match. So similarly, a derivative is a bet on the future value of an asset. So instead of betting on a soccer match, in finance, you might bet on the future price of a stock. Okay, for example, you and another person could make a derivative contract agreeing to exchange money based on whether the price of a specific stock goes up or down. Now, it's super important to note that derivatives can be very complex and they can also involve a significant financial risk. Okay, if you play with derivatives, you can lose all of your money. Okay, they're mainly used by sophisticated investors and institutions to manage their exposure to various assets. Okay, so it can be a bit confusing, but hey, derivatives is another financial word that's interesting and important to know. Okay, but as a financial investment, they can be very confusing and they can also be very risky because you're betting on the future. You're making predictions about the future price of an asset. Okay. All right, so there you have it, my friends. That's a list of financial vocabulary that you must know if you want to work in the world of finance and business. Now, some of these concepts, as I mentioned, can be a little complex to understand, so I encourage you to find the translation in your native language and then understand the concept behind each one, and then you'll be able to use them better in English and speak more confidently because you'll understand what they mean. Well, that's it. That's all from me today for this episode, but be sure to subscribe and comment on this episode. I love to hear from you. So I'll see you all in the next episode of The Art of Business English. So take care and bye for now. And thanks again for listening.